Hello traders and welcome back. I'm Natalie MacDonald. You're watching Sydney Direct and this is Dukascopy TV. My next guest is Dr. Shane Oliver of AMP Capital. We're talking the Aussie dollar, the Australian economy, and what we could expect from both the RBA meeting minutes coming up and also those capex figures. Will we see a turnaround from Q1's disappointing data? Here's what he had to say. Shane Oliver, thank you so much for taking the time to chat with Dukascopy TV once again. Always a pleasure to catch up with you.
Likewise, thanks for having me on.
No problem at all. So let's start firstly with the RBA meeting minutes as we've seen them this week. A real highlight was that leaning on APRA to put the lid really on the property price chaos that we've seen. Is this the RBA passing the buck, or is it simply they've realised they're not best positioned for preventative measures in this scenario?
Well, in normal circumstances, a housing recovery would go hand in hand with economic strength, and so the Reserve Bank would feel that it is its responsibility to slow it down, and they do that, of course, by raising interest rates. This time, I think the Reserve Bank thinks, well, we don't really want to raise interest rates because the rest of the economy wouldn't bear it, but we need to do something. So let's have a chat with APRA, which is the regulator of the banks, and have them do something, which is basically what we've seen. We've seen APRA direct the banks to slow down their lending to property investors, and the evidence suggests that is starting to bite. But so I think it's just the RBA recognising the reality of things, that they're not in a position to do anything. They've got to get APRA to do it.
We've also seen with the Aussie dollar, it seems very much stuck between a rock and a hard place in the shape of the US Federal Reserve and also China. Really, we keep seeing that there's clearly some downside to the Aussie dollar on those reactive slumps. What keeps prompting that rebound?
Well, I guess currencies rarely go in one direction indefinitely, and we've seen over the last 4 years the Aussie dollar come down dramatically from $1.10 US now to around 73, 74. But on the way through that 4-year period, we've seen several occasions where investors globally particularly have got themselves very short the Australian dollar. If there's just a slight change in the comments coming out of the Reserve Bank, then those investors are often prompted to close down their short positions, and you get a bounce back in the Aussie dollar. And you can argue, recently we've had a big build-up of short positions. The Reserve Bank has done something similar again. It's dropped its reference to a further fall in the Aussie dollar being necessary. So there is some chance you might see a bit of a further bounce in the Aussie dollar. Indeed, it has come off its lows recently, and there is a chance you have a bit of a bounce before it resumes that downswing. But I think in a world of falling commodity prices and where Australian growth is starting to lag growth in the US, that sort of environment will see the trend remaining down, notwithstanding occasional bounces.
Now, both of the items we've discussed already, property prices, Aussie dollar movements, have been sort of key drivers for the Reserve Bank. We have a meeting coming up next. What is your outlook for that, or perhaps for future meetings?
Well, at the next meeting, I think the Reserve Bank will leave interest rates on hold. So one gets the impression from reading their recent commentary that they're feeling fairly comfortable about things. They claim that recent economic data has been, if anything, a little bit better than expected. I think they feel that the potential growth in the economy has come down, lower population growth. Therefore, there's not as much spare capacity as they'd previously allowed, and the unemployment rate is not as high as they'd previously thought it would get to. So all of those things suggest on hold for the time being. But my feeling is that somewhere out there still, the Reserve Bank will have to cut interest rates again, simply, well, for two reasons. One is the Aussie dollar, I think, is still too high at these sorts of levels, needs to be lower, so they want to maintain downwards pressure on the Aussie. On top of that, economic growth in the economy is still running below levels. Even if the Reserve Bank downgrades its potential growth for the economy is still growing below that downgraded assessment. And that in turn means there's still spare capacity out there, still 14% of Australians either unemployed or saying they want to work more hours, and that's a pretty high number. And so all of that, I think, will point to another interest rate cut. There's another little sneaky issue going on in the background here, that APRA have directed the Australian banks to put more capital aside. That raises the cost of funding for the banks. They may actually put through mortgage rates for existing homeowners, owner-occupiers as well as investors, and that's the last thing the Reserve Bank would want to see at the moment. So to offset that, the Reserve would probably have to cut interest rates again. So there's certainly some reasons out there why I think the Reserve will cut, but not at the next meeting.
Now, one of the upcoming economic indicators I'm pretty excited about is the Q2 capex figures we've got coming out next week. Now, are we likely to see some improvement from those disastrous Q1 figures?
Well, the capex numbers are big in the sense that you get information all the time, every month at least, on consumer confidence, on retail sales, housing approvals, all the other things in the economy, except investment, which only comes out once a quarter. So those numbers are going to be watched very closely for two reasons. One is the ongoing slump we're seeing in mining investment and how that's going. That's probably going to continue heading south. Hard to be optimistic on that front. Flip side though, and the key here is what the outlook looks like for non-mining investment. So not only does the ABS ask Australian companies how much they invested last quarter, but they ask them about their plans for the financial year ahead. My feeling is that we'll probably see some stabilisation. Those plans were deteriorating, implying a weaker outlook for non-mining investment. If you look at recent business surveys, for example, National Australia Bank does one, there has been on balance a bit of a slight improvement in confidence amongst businesses. If that flows through to capex plans, business investment plans, then it should at least point to a stabilisation in the outlook for non-mining investment. So these figures are certainly going to be watched pretty closely in Australia, but hopefully they will show some signs of at least stabilisation in investment outside the mining sector.
Well, we know should they not prove successful, I have no doubt Treasurer Joe Hockey will be pointing fingers in all directions. Shane, thank you so much for the time today. Much appreciated.
It's my pleasure. Thank you.
Sadly, that is all we've got time for right now, but do stay tuned as the Dukascopy TV team continue to bring you all of the FX updates and exclusive analysis. For now, though, it is goodbye from me.